Now you can tell this one's an epic because I'm dressed up. Anyway, so this bloke comes up to me and he says, what's the worst job you've ever had? And I tell you, whatever it wasn't as bad as being the Chancellor of the Exchequer. If they offered that to me, I wouldn't touch it. I'd rather be a destitute. And I'll tell you why. Last time we talked about inflation. We talked about how that sequence of events led to a cost of living crisis. We also talked about how government tried to buy its way out of this and ended up massively indebted as a result. Now that national debt is now the elephant in the room. And if you've got a minute, it's a large pachyderm with a very, very bad attitude that might just be about to trample its way through your finances. What are you looking at? Now, to understand the predicament we're in, we need a little bit of a primer in what government does with money. Now, government spends about 1,200 billion quid a year, about £17,500 per person. Most of that goes, about 2/3, goes on public services. That's healthcare, welfare, education and defence. Government raises most of the money that it spends through taxation, principally income tax and national insurance, with a little bit from VAT and from companies. However, governments typically spend more than they raise, and they cover the gap by borrowing. When they borrow, they issue a bond, which is a promissory note to pay back the loan at some point in the future with a little bit of interest in between. Investors are often interested in stock markets, but a government can't sell shares in a country to raise money. Well, not yet at least. So when government needs extra money, they go to what's called the global bond market. And this is where financially institutions and countries that have excess money loan it to those who haven't got enough. The bond market is much bigger than the stock market. And because it's where governments go to raise money, it's arguably more important than stock markets. Now, when a loan is being assessed, the rate of interest that the loan pays is going to be based upon the chance that the person who's been loaned the money won't pay it back. Very intelligent people with thick-rimmed glasses and scientific calculators called actuaries work out this default risk and set the interest rate on a bond. Actuaries absolutely love solid, dependable, conservative governments because they can be relied on to pay their debts. And it's a little known fact that the British government is the only government in the world that has never defaulted. So actuaries love lending the money, and they've loved to lend the money at very, very reasonable rates, which has been good for everyone. So that's how governments raise money. To understand the problem we're now facing, and that's an angry elephant clutching the government purse, we also need a little bit of historical context. Here we are in the city of London, now a thriving metropolis, but 100 million years ago it was just a chalk bed covered with a thin sea. About 500 miles to the north that way, however, was a dinosaur holiday hotspot. Unfortunately, 65 million years ago, a chunk of rock hits the planet and all those dinosaurs have a really bad day. But a few small, like shrew creatures, which were mammals basically, survived. By 1700, one of those shrews had evolved into King William III, who at that point was having a real worry about the nation's wealth, its coinage and counterfeiting. So he turns to the smartest man in the kingdom, Sir Isaac Newton, who's just got through inventing gravity, to come up with a solution. And he comes up with something called the gold standard, where the nation's wealth is held by the Bank of England as lumps of gold. And because gold's quite hard to carry, the Bank of England issues promissory notes, or banknotes, which are unitary bits of value, but you can exchange that value between each other. Now, flash forward to the First World War, and the British government recognises that it hasn't got enough gold to prosecute the war. In fact, based upon the amount of gold, the war would have been over by Christmas. So what government does, it starts to borrow. And it does that by issuing war bonds to its citizens, which is essentially a promissory note to pay back the loan once we've seen off the bosh. A post-war boom allows us to recover that debt. All goes horribly wrong with the Great Depression though, and a couple of decades later we're back at it again in Europe. Britain stands alone and it can't afford to fight the war. So we turn to our cousins across the pond and we start borrowing from the United States. We eventually see off the axis, but as a result of that process, the country is broke. We've got no choice but to sell off the estate. So the largest empire the world has ever seen basically collapses down to an artisan sausage factory in Cameroon and a very fetching bungalow in the Isle of Wight. In doing so, our share of global wealth shrinks from 20% down to 5%. Golden age of capitalism ensues, which allows us to pay off the debt, focus on delivering the post-war socialist dream, and getting back to the business of having babies and raising families. Unfortunately, the people in Whitehall haven't done their sums properly, and pretty soon, welfare costs spiral out of control to the extent that by the 1970s, the country's nearly broke again. Now, fortunately, just in the nick of time, we discover oil in the middle of the North Sea, which is those dinosaurs that I mentioned 100 million years ago. And that replenishes the coffers. Also, British business kind of gets its act together in an increasingly globalised world. And before you know it, the City of London is a centre of finance for the entire planet, to the extent that by the mid-80s, 25% of all of Britain's income is being generated within this square mile. Now, by this time, though, there's been an explosion in the population. There's been a post-war spike in birth rates, and all the baby boomers now want a house. Easy lending leads to a bubble in the housing market, and when that goes pop, it takes with it layers of interconnected and highly complex financial structuring, which is a little bit like a Russian doll of bad debt packaged up and sold within more bad debt, sold within more bad debt, packaged up and sold, and you get the idea. The banking system nearly collapses, and government is forced to step in and bail out the banks, and it can only do so by borrowing billions from the bond markets. And just when we got over the economic cold of the credit crunch, we catch a real cold with COVID-19. The pandemic sweeps through an older, more morbid population of baby boomers. By this point, there's only 2.5 NHS beds for every 1,000 people. And that's a little bit of a tight squeeze, and the healthcare system, it looks like it's about to be overwhelmed. So, government initiates a lockdown. We stay at home, we don't go to work, we don't get any income, and therefore we don't pay any tax. So government, once again, is forced to go and borrow huge sums of money to pump into the economy to keep it afloat. All of which you already know, which begs the question, so what? And why are we talking about elephants? I'm glad you asked. By 2021, government is left carrying an absolutely massive debt amounting to 3 trillion quid. That's a 3 with 12 zeros behind it. And to give you some kind of perspective on that, if we brought Isaac Newton back with his gold standard and we converted that debt into gold, it would weigh about 1,500 tonnes. And if that landed on your foot, you'd know all about it. To put that in perspective, government debt was over 100% of how much the country makes every year. Interest payments alone made up 8.5% of all spending, at a time when our share of global GDP, total global wealth, has shrunk to less than 3%. Now, naturally, any self-respecting bond market actuary looking at UK public finances is going to start entertaining some questions about our ability to pay. Then, in September 2022, like some exotic subatomic particle, Liz Truss popped into and out of existence in 10 Downing Street, and she arrived with a genius plan to grow our way out of this. The seminal idea being to heap more debt on top of the already massive debt, on the idea that you're going to then invest that debt in the UK economy. The economy is going to grow to allow you to pay off the debt. And if that sounds like the kind of plan you could drive a double-decker bus through to you, you're not alone. It was the same for everybody else. And if you've got a minute, it's because it's highly speculative, extraordinarily risky, and stands an extraordinarily chance of going horribly wrong and making things an awful lot worse. In fact, if you stop to think about it, which maybe is the kind of thing you might expect a Prime Minister to do before coming up with a plan, it's absolutely antithetical to the way actuaries in bond markets consider risk and loaning money. Not surprisingly, bond markets flew into a panic. Actuaries then totally reassessed the risk of the UK defaulting on its debts and hiked interest rates, the amount payable by the UK government, by 10%. A week later, an entirely new Chancellor had to convene an emergency budget to introduce eye-watering amounts of tax just to cover the increase in interest payments. So brilliant work there. Philosophers still debate whether Liz Truss was in fact real. However, they are all agreed upon the fact that generally people don't like paying eye-watering amounts of tax. And so it was that a very disgruntled electorate swept Labour to victory in the next election with a landslide, bringing with it a new Chancellor and a new hope. And so it was. Our first female Chancellor, Rachel Reeves, stepped up to deliver her first budget and a genius plan to grow our way out of this. The plan being to heap more debt on top of the already massive and now increasingly expensive debt, and then invest that debt into the UK economy in hopes that that economy would grow and that would allow us to pay off the debt. And if that sounds strangely familiar, it's because it was. And did that work? No. Curiously, a central plank of the plan was to stimulate business growth by taxing businesses more. Now, every academic study on the subject has demonstrated that if you tax businesses less, the total tax take to the Treasury actually goes up. And the reason for that is businesses can invest more, grow the business, employ more people who then pay more income tax, which effectively is something that an economist would be expected to know. Rachel Reeves being a self-confessed economist, which has led philosophers to consider, was she looking at the graph upside down when she was planning the budget? And did that work? Well, no. Actually, as a result, employment costs went up, business investment went down, and international confidence in UK businesses dropped. The Office of Budgetary Responsibility, which is like a financial watchdog that oversees what the government does with its money, now estimates that growth in the UK is half what we would otherwise expect for 2025. So excellent work there. So what's basically happened is, over the last 100 years, a series of seismic social problems have ramified up to government. They've not had the money to deal with them, so they've had to go and borrow. And that's led to massive levels of indebtedness. Equally, financial ineptitude has called into question the ability of governments to manage those debts, which have led to actuaries in the bond market rising the levels of interest payments that they require. At the same time, our share of the global financial pie has shrunk to the point where our share is now about 3% of global wealth, calling into question our ability to pay for that debt. And taking all this into account, any self-respecting actuary is going to have to ask themselves some fairly deep, soul-searching questions about whether they want to continue lending to the British government. And it's against this backdrop that Rachel Reeves is going to announce her next budget in November. She wants to spend more, but we haven't got any money. She'd like to borrow more, but that's becoming prohibitively expensive. Also, she has a manifesto pledge not to raise taxation on working people. So what's a Chancellor to do? She could try cutting back on spending on welfare. The issue with that is we have a larger and ageing population, the cost of which is increasing, so that doesn't leave a lot of wiggle room. And also, there's a growing budget for defence in a world that is looking decidedly fruity. She could invest in technology to increase productivity, but the problem with that is there's a fairly long lead time, so that's not really going to help today. The other thing she could do is she could think about something really radical. So she could ask the Bank of England, for example, to drop interest rates, which would push inflation up, with the idea that you amortise the debt. The idea being, like with your house, where the value of the house, or the economy in this case, grows away from the value of the debt, and you end up with more money as a result. The problem with that is that with an ageing population, our pension benefit system is index linked. So basically, if you cause inflation, that's just going to make the debt even worse. And then the final thing you could do is you could try something really radical, like, for example, rethink welfare and healthcare. The problem with that is that ageing population is also increasingly morbid, and the cost of looking after it is going up. Also, healthcare is kind of like a political hot potato, and it's one that politicians really don't like handling, which really leaves her with one choice, which is to hand the national debt back to the individuals, which is also known as higher taxation. All of which creates a couple of worries. The obvious one is, however you dress it up, higher taxes are going to be piled on top of a higher cost of living, making life just a bit tougher in the near term. In the longer term, that also means less money to pass on to future generations and preserve wealth within families, propagating the problem in the very long term. Now, did I say at this point that this is the good news? Then consider what happens when the next crisis lands. If government doesn't have the resources to meet this, it implies more onus on the individual to look after themselves. But higher personal taxes leave less discretionary spending power available for the individual to deal with the fallout. So possibly some hard yards ahead. And best not to think about the fact that there are less people working than people who don't. With an ageing population, that dependency ratio only gets bigger. So you must get to the point in the not too distant future where even if you taxed everyone who was working by 100%, you still haven't got enough money to pay for everything. And actually there's no good choices at that point. All of which tends to suggest we may have arrived at a critical inflection point. What we can also see is that we can't rely on governments to fix these problems. We probably also can't rely on banks to fix these problems. And would we really want to rely on those naughty bankers anyway? Ultimately, the elephant in the room isn't about to pack its trunk anytime soon, meaning that we're going to have to deal with it. Now, in this context, there is an old Vulcan proverb that when asked how to eat an elephant, the answer is, logically, one bite at a time. And in dealing with the current elephant room, it's actually a very similar approach. And we'll do so with consistent steps of systematic planning taken in the longer term and in response to the objective facts. If you've got a minute, in fact, it's exactly the kind of boring systematic planning that actuaries in the bond market really get off on. Now, given the current predicament, there probably are a number of strategic implications that one might consider to deploy later on. So, for example, we could attempt to outpace any increases in taxes, potentially taking a more aggressive approach with our investments so we have a greater absolute sum of money to pay the tax and have more money left over. We could also try to outmaneuver the Chancellor a little bit with greater tax diversification. So, for example, rather than simply using a pension to plan to retirement, which is subject to the income tax regime, one might use a pension, an ISA and a bond, all three of which have different tax treatments. Now that might insulate you to some extent from statutory change. The other approach one could take would be to try to outnumber the Treasury to some extent and do so with collective strength. So we do this to some extent in the practice by leveraging our collective strength and buying power there to get lower fees. The natural approach, of course, being also in your planning, is to work together as a family on a generational basis to create and pass on wealth. I think probably the most important implication, however, is that in the lead up to the budget, whatever wild media speculation goes around about what Miss Reeves might do, is that we should not succumb to that, and we should actually wait till after the event to see what Miss Reeves actually does, and then respond in a measured and appropriate way to that. And it's on that note, we'll see you next time.